Welcome to Chapter 11, and in this chapter we're going to be talking about depreciation, depletion, impairment, and disposal. And I'm going to just skip over these and get right to the point. So with assets that we are not going to obviously expense in the year that we acquire them, we need to develop some sort of expense allocation method over some period of time or period of use. And what we call that process depends on the nature of the asset. So if it is a tangible asset, we call this form of cost allocation depreciation, and this would apply to property, plant, and equipment. If this is a natural resource, oil and gas, timber, things like that, that's referred to as depletion. And then if it's an intangible asset, goodwill, patents, or copyrights, we call that amortization. The overall concept is the same in terms of allocating the cost over some factor, but how we reference that depends on the nature of the asset. So when we're looking at what factors are involved in depreciation or depletion or amortization, we need to look at a number of factors. And specifically for depreciation, where we're looking at tangible assets, we're looking at the asset cost, the service life or its useful life, the residual or salvage value, which is the concept that everything is worth something at the end of its useful life, even if it's just scrap value. So unlike when we calculate depreciation for tax purposes, where we depreciate something right down to zero, for GAAP purposes, we need to calculate this salvage value, and then we only depreciate the item down to the point of the salvage value. And we need to employ a methodology that is systematic and is rational given the nature of the item that we are depreciating. So first, we start out with trying to figure out what our depreciable base is. What are we looking to depreciate? And that calculation is the asset cost minus the estimated residual or salvage value. Then we can employ a number of depreciation methods. We can use the straight line, or there are a couple of accelerated depreciation methods, and these are based on time. Or we can use activity-based, machine hours, units of production, or something similar. And we can do either group or composite. We'll first talk about straight line. And straight line is the most commonly used method of depreciation. It takes the cost of the item, oops, I don't know how that happened. Anyway, we subtract the salvage value and we divide that by the estimated service life. And so and we've got the example here we're going to use of Troop Company, and they've got an estimated residual value of 20,000. Service life is 5 years or 10,000 hours, and then they discuss the actual usage here. So if we're going to use this straight line method based on time as opposed to service hours, we've got a $120,000 asset, and we need to make sure, again, that we don't depreciate that below the salvage value. So in order to do that, we calculate out the amount of depreciation per year that will allow us to do that. And so at 120,000 minus 20,000, we're looking at $100,000 over 5 years, or $20,000 per year. So if we apply this depreciation expense equally throughout the asset's useful life, we end up with a book value at the end of its useful life of our $20,000 salvage value. There are also accelerated depreciation methods. And so one is called the sum of the year's digits. And so what we're going to do in that situation is we're going to determine how many years the asset is going to have a useful life for. And this is almost be easier to show you than to explain it. So what we do is this is a 5-year asset. And so what we do is we add up the years of the asset's life. So we've got 5 plus 4 plus 3 plus 2 plus 1 equals 15. And 15 will be our denominator. And the year we happen to be in will be our numerator. And this will be the factor that we multiply our depreciation base against for each of the assets, each year of the asset's useful life. So the first year, 5/15, that comes to 1/3. So we're taking 33,333 as depreciation expense in year 1. Then we've got a book value at the end of 86,667. And so for each year, we multiply this factor based on the sum of the digits based on and against the depreciable base, and we get our depreciation expense each year, leaving us, of course, with our salvage value at the end. We also can do something that is an accelerated depreciation method called declining balance. And most common, you'll see double declining balance or 1.5 times, or you'll see 150 declining balance depreciation rate. And so what we do is we calculate what would be the straight line depreciation over the asset's life. And in year 1, we double that. And I will find an example which will probably make this more. Okay, so we've got an example here. We've got an asset with a 5-year useful life, and we're going to, over 5 years, we would depreciate theoretically 20% per year, but we're going to double that. And so in year 1, we're going to multiply the book value at the beginning of the year by 40,000. And then that gives us our depreciation expense of 48,000. We then we've got a new book value at the end of the year, which becomes our beginning of the year book value for the next year. And we multiply that times 40,000. We take our expense, and at the end of year 2, we've got a new book value, and we will multiply that times 40%. Now, once we reach a point where we are going to cut, if we were to continue at that rate, we would depreciate our asset below its salvage value. We basically have to kind of truncate the depreciation that we take in the year that we would have inadvertently done that, so that we can make sure that we don't inadvertently go below the salvage value. So at the end of year 3, we had 25,920, and 20,000 is our salvage value. So all we can take in year 4 is the 5,920, and then no depreciation in year 5. And that's for the double declining balance method. If we'd used the 150 declining balance method, we would have taken that straight line over 5 years, which would have been 20% on a straight line. We go 1.5 times that. That gets us to 30%. And we follow the same methodology. It's just with a different multiplier for the 150% declining balance. We can also depreciate something over its service hours. Quite often when you're dealing with machinery, you're dealing with machine hours, or you could be dealing with units of output. It can make, 50 widgets in its useful life, for example. So here we've got, for our same machine that we've been doing the depreciation with over time, instead we're going to deal with it over activity hours. So we anticipate that we've got 10,000 hours for this item's useful life. If we subtract out our salvage value to get our depreciable base, $100,000 divided by 10,000 hours, we're going to depreciate this at a rate of 10,000 per hour. And then we look at our actual activity level for each year, multiply that by $10 an hour, and that's how we get our depreciation base for each year. And again, making sure that we don't go below our salvage value. When we record depreciation, we don't ever modify the book value of our item in our balance sheet. Instead, we've got accumulated depreciation that is a contra account that will, so we'll first show the asset at its original book value, and then show the accumulated depreciation that's been taken, subtract that, and that gives us our new book value. So it's readily apparent from our balance sheet what the original cost was and how much depreciation we've taken on this item up to that point. And so a journal entry that we would take is depreciation expense, debit, and then we credit accumulated depreciation. And I'm going to stop here and we will go on to the next video.